If you have been following the semiconductor space, and honestly, who hasn't lately, you've seen some truly dizzying price action.
Especially around AMD.
Oh, especially AMD. Just recently, we saw one of the most aggressive bouts of volatility I can remember. A sharp intraday dip, and then boom.
An absolute rocket ship V-shaped recovery. It was a classic moment, really. You could almost see the institutional drama playing out in real time.
You really could. And that kind of whipsaw motion, it's the market signaling that, major players are battling it out.
But that's not even what really captured our attention, is it? What we're doing a deep dive on today is the emergence of this highly ambitious street-high target price.
Right. We're going to unpack the analysis confirming that number. So right now, AMD is trading around, what, 214, 215?
Just about, yeah. $214.99.
And the target we need to get our heads around, the one that has just fundamentally shifted the conversation on Wall Street, is $310.
And that target, which is confirmed in this new analysis report, it implies a breathtaking move.
I mean, the math is just huge.
It is. We're looking at a 44% upside from where the stock is right now. And if you happen to be watching those sharp lows during the volatility, the potential upside from that temporary floor climbs closer to an astonishing 60%.
That is nearly $100 per share of implied future value. So our mission today is to cut through that huge $310 number and really unpack the specific data, the assumptions that analysts are using to justify this.
This hypergrowth expectation.
Exactly. Why are they suddenly repricing this company, not for next quarter, but for years out? Okay, let's unpack this core thesis. This is a monumental shift.
It truly is. This $310 target is not, a simple projection. It represents a complete shift in how Wall Street perceives what AMD is.
And the first clue is the timeline.
The first thing you notice.
Yes.
Why anchor this massive target price to fiscal year 2026? It's 2 years out.
That timeline is so critical, isn't it? It signals that this analysis is completely forward-looking. It's almost like it's discounting AMD's legacy businesses.
Completely. The old narrative about CPUs and traditional server chips must be, completely off the table for this to make sense.
Right.
Precisely. The core narrative driving this $310 high case is the fundamental assumption that AMD is being completely repriced. They're no longer seen as just a high-quality, cyclical chip maker.
A company that just ebbs and flows with the PC cycle.
Yeah, exactly. Instead, they're being categorized and valued as a dominant, indispensable AI infrastructure play.
Okay, let's clarify what that distinction means for someone listening, because reclassification can sound a little abstract.
Sure.
But in financial terms, it's the difference between, a high single-digit PE and a triple-digit PE. What's the practical valuation difference?
It changes everything. A traditional semiconductor stock might trade at, let's say, 25 to 35 times earnings. It reflects those cycles, the capital intensity.
The usual stuff.
The usual stuff. An AI infrastructure play, like this analysis is defining it, is viewed more like a platform provider. A utility, almost, for the biggest growth engine in the global economy.
And that designation just lets the valuation multiple completely de-anchor from historical norms.
And shoot into that hypergrowth territory.
And we don't have to guess that the market has already bought into that narrative, do we? I mean, we can see it right in the current valuation. It's eye-popping.
It is. The stock's current price to earnings, the PE ratio, is approximately 106.
106.
And that 106 PE is the number we have to keep coming back to. It signifies that the market has already priced in years of exponential growth.
So the $310 target isn't just pricing in future growth.
No, it's pricing in a near certainty of massive AI market share expansion and flawless execution over the next 24 to 36 months. That's a huge psychological hurdle.
Which brings us to the foundation. These aggressive targets can't just be built on hope, right? They have to be grounded in projected revenues and earnings. So if we accept the premise of AMD becoming this AI infrastructure play, what's the actual financial firepower here?
Right, we have to move from the narrative to the hard numbers that fuel it. And the analysis, it highlights a truly massive revenue forecast as the baseline.
Okay.
AMD is projected to deliver nearly $34 billion in total revenue for the upcoming fiscal year 2025.
A $34 billion forecast, that's a whole new weight class for them. But where is the torque for that engine coming from? That kind of growth can't be evenly spread out.
Not at all. The entire momentum, the projected engine of this growth, is centered squarely on one thing: data center growth.
Okay.
This analysis sees the data center segment, specifically the high-end server and AI accelerator sales, as the sole driver justifying these multiples. Any disappointment there just shatters the whole thing.
And that focus on the data center leads us right into profitability, because high revenue is one thing, but profit is what confirms the value.
Exactly.
If they're selling more of these super complex AI chips, we should expect margins to expand pretty dramatically. What are the forecasts there?
The analysis suggests a very positive and necessary shift. Gross margins are expected to increase significantly and are forecast to move toward 54%.
54%. Wow. That is not only fantastic, but it's hard evidence for that AI infrastructure narrative, isn't it?
How so?
Well, the only way you get from the mid-40s into the mid-50s is by shifting your product mix that heavily towards those high-end, high-value AI chips.
The ones that carry much higher price tags and better margins.
Right, much better than their traditional stuff.
And that margin forecast is the direct result of that. And the success in earnings, it leads us to a crucial concept for you to understand: valuation compression.
Okay.
The analysis forecasts an earnings per share, or EPS, of $3.12 for next year.
So we've got a $3.12 earnings forecast sitting underneath a stock that's priced at 106 times earnings. How does the growth in earnings stop the stock price from eventually just, collapsing?
It's a great question. Think of the stock price right now as a race car that has sped way ahead of its own headlights.
Okay, I like that analogy.
The price is based on hope and future potential. $310. The headlights are the actual earnings. If those earnings at $3.12 EPS were to stay static,
The car would crash.
the stock would eventually crash as reality sets in. But the rapid growth in EPS that projected $3.12 and beyond is essentially helping those earnings headlights catch up.
Illuminating the path the stock is already on.
Exactly. This growth effectively compresses that super high PE valuation over time, even as the stock price goes up. The faster the earnings grow, the more sustainable the price becomes. It's a really delicate balance.
That frames the mechanics perfectly. The valuation is a bet, and the earnings growth is the foundation being rushed into place to secure it. Let's move to the ultimate AI catalyst, the thing that has to happen in the real world for that $310 to even be possible.
This is where the analysis makes its biggest leap of faith. To justify this street-high target, there is a fundamental, non-negotiable assumption baked right into the model.
And that is?
AMD must successfully capture 20% of the overall AI accelerator market.
20%. That is a massive market-defining number, especially when you consider the competitive landscape. I mean, NVIDIA has a near monopoly right now, right? Maybe 85, 90%.
They do. And this analysis doesn't really suggest a zero-sum game. It relies heavily on the overall market pie just expanding massively.
So it's not about taking from NVIDIA necessarily.
Not entirely. The projection is that demand from the hyperscalers, the big cloud giants, is so insatiable that they are desperate for robust second sourcing options.
Through reduced risk and dependency.
Exactly. 20%. In that context, is seen as AMD becoming the reliable, high-performance alternative for that massive expanding demand.
So which products are driving this? We need specifics.
We're talking about the current flagship, the MI300 series, which has already established a footprint.
Right.
And crucially, the successful execution and timing of the upcoming MI350 series. This is where that 2026 timeline becomes so important.
This isn't about incremental gains.
No. It hinges on AMD's ability to execute flawlessly against what the analysts are calling the 2026 AI supercycle.
Which is when all the massive infrastructure refreshes and standardization will happen at the big cloud providers.
That's the idea. So that execution window for the MI350 is the make or break moment. If it slips, the whole thesis fails.
The $310 price target is essentially a bet that AMD delivers that next-gen accelerator on time at scale.
Fulfilling the needs of companies desperate to diversify their AI supply chain, yes.
Okay, so the thesis is clear. $34 billion in revenue, 54% margins, 20% AI market share, all driven by the MI350 in the 2026 supercycle. That's the long-term story.
That's the story.
But let's talk about market reality. Theory is one thing, but how is the market signaling its conviction right now? Let's shift from the forecasts to the immediate technical behavior the analysis uses as confirmation.
This is where we look at the trading action itself, which is often the purest signal of institutional belief. The analysis singles out the chart action from that volatile day, December 26th.
The day of that wild V-shaped recovery, the stock got hammered down, then just bounced right back.
Exactly. The key takeaway from that intraday chart is the swift, aggressive recovery after what was clearly a significant attempt by sellers to push the stock down.
This wasn't just retail fear.
No, this was large-scale selling pressure, possibly even a stop hunt operation to flush out the weak hands.
And the specific number here really matters. The analysis points to the low point of that dip, $213.03. Why is that exact number so important?
It's the moment of maximum conviction. The analysis interprets that action as confirmation that institutional buyers are not just interested. They are actively and strongly defending the $210 to $213 price level.
So when the stock tested that $213.03 level,
The buying pressure was just overwhelming. That's what led to that instantaneous, pronounced V-shaped bounce. This establishes that range as the critical floor or support level, and it's backed by real capital.
this gives us a concrete line in the sand for anyone listening and following this analysis. That $213 floor is the market's current vote of confidence. So what are the trading implications if that floor holds?
The analysis is pretty straightforward on this. It gives you a clear risk-reward framework. As long as the stock holds above $230, The technical path of least resistance is upward.
Okay, and what's the first hurdle?
The first immediate technical hurdle is clearing the recent 52-week high of $267. Once that level is secured, the market's attention and the institutional money will shift directly toward testing that fundamental target, the ambitious $310.
So the market action above $213 confirms the bullish momentum is dominant.
That's the interpretation, yes.
This has been a complete breakdown of how one number $310 is being justified. It's an aggressive future narrative that requires perfection on all fronts. Let's bring it all back together. Summarize the key pillars of the bull case from the analysis reports checklist.
Okay. First, the revenue. The fuel for the thesis is a record $34 billion next fiscal year, almost all from the data center.
Second, sentiment. The analysis points out conviction is high across Wall Street. 80% of current analyst ratings are buy ratings. That shows widespread professional belief.
Third, the technicals. We have confirmation from the chart that V-shaped recovery confirms strong institutional demand right at the crucial $213 support level. The floor is holding.
And finally, the all-important catalyst. Everything relies on the success and perfect timing of that looming 2026 AI supercycle.
Driven by the MI300 and MI350 and AMD's critical need to capture that 20% AI accelerator market share.
Right.
So the final takeaway for you, the listener, is that the volatility we saw recently, that sharp dip to $213.03, should probably be interpreted not as a crash, but as an opportunity provided by the market for confident buyers.
An opportunity to step in.
An opportunity to step in. Given that the strong $213 floor is holding, the fundamental thesis is still completely intact, and that $310 target is now officially on the table as a serious possibility.
It definitely puts the stock in a new light, requiring you to think far beyond just the next quarter. But I want to leave you with one final thought on that hyper-growth PC. We spent time explaining how that projected EPS growth of $3.12 is needed just to start compressing the current sky-high valuation of 106. But if AMD is successfully meeting that growth rate next year, how much faster must AI adoption accelerate across the entire global economy, not just at AMD, to maintain that PE or even justify a higher one?
That's a great question.
And what would that implied acceleration mean for the fundamental valuation of every other company in the semiconductor and enterprise software sectors? That's the true scale of the risk and reward baked into a $310 target.